All right, what's going on, guys? My name's Hamilton here with the Trading Initiative. In today's report, we're going to be going through the weakest stocks in the market. I don't know why anybody would want to short the market less than 1% away from all-time highs, but you want to know something. It's always nice to build out a watch list of the weakest stocks that you can short in the event that something does happen, something does change in the market characteristic. You're going to want to know which stocks were lagging in a market that is potentially going to break back out into all-time highs very soon. Thought process here is that if the market does break down, we start trending lower, the weakest stocks in a bull market should be the absolute weakest stocks in a bear market, because if nobody wanted to own them when everything was going up, who the hell is going to want to own them when everything's going down? So we're going to go ahead and start with this Bear Tracks report. We put this out once every other week. And what we're looking at here are the biggest losers in this bull market. We take out micro and small caps. We add some liquidity filters. And then we try to filter them by distance to 52-week lows. We're really looking at the worst of the worst here. And as you can see, if you've been looking for shorts, a lot of these companies have been in declines for a relatively long time. We have a 52-week spark line chart here as well. You can see that typically weak stocks continue to get weak. And that's really where I want to start here. Obviously today, a pretty good day in the market. Once again, we're very close to all-time highs. But I think there's a valuable lesson to be learned here. We're going to look at two stocks in particular that are really what you wouldn't expect if you were trading the market logically. We're in the third year of a bull market. Whether or not you want to admit it, I'm sorry, we are. Stocks are still going up more than going down. Looks like the indexes are going to prop up. For whatever reason, UPS has never joined this bull market. As a matter of fact, it peaked in the beginning of 2022, and it has yet to actually reclaim that level. And the lesson here is cheap stocks tend to get cheaper. As technical traders, we do not necessarily care about why they are getting cheap. We just need to identify that they're getting cheap. And if the idea here is to short them, take shorts. If the idea here is to long these things, it's to stay the hell away until they've shown us enough proof that they want to start popping back up. Now, the reason why I bring up UPS is it's UPS, right? This is, at one point, I believe the largest public freight and logistics company in the United States. It's down 50% from its highs in early 2022. Just has not been able to catch any sort of momentum to the upside. How many people do you know or have you seen on social media say, I'm going to buy UPS, it's down way too much, there's no reason why it should be this cheap? They're looking at things like earnings, PE ratios, they're looking out into the future. What I see here is a lower high, lower low situation with the stock price trading below its 200-day moving average. There's no reason to own UPS in my mind as a technical trader until there's a floor that's found and a potential technical bounce, right? UPS, cheap stocks continue to get cheaper. Tends to happen. Nike is another great example. It's Nike, right? Nike peaked in late 2021, has never been able to really rally even as we're in the third year of a bull market. We're trading below a downward sloping 200-day moving average. Once again, no real momentum to the upside. We've had little bursts here and there, but really there's nothing here that changes the primary trend from a technical standpoint. So once again, UPS, largest freight and logistics company in the United States. How the hell is it down 50%? Nike, arguably, at least for a long time, my generation, I'm a millennial, this was the most important sports apparel company in the United States, potentially around the world. Nike, maybe Adidas, but Nike had the market share there, and even Nike is down a ridiculous amount from its all-time highs. It's bounced up a little, 60%, right? So if you're thinking about this stuff logically, I'm using logically in air quotes, you're not going to have a good time because the market does not give a shit about what you think about a company. The market's going to do whatever the market wants to do. So as soon as you kind of surrender yourself to the idea that the market is going to do whatever it wants, and then find some sort of system that will allow you to make money, given the fact that the market, you have no control over it. You just manipulate how you're going to take advantage of the market, not the other way around. Then you'll potentially start making some money. So Nike, UPS, two good examples of cheap stocks continue to get cheaper. And there's a lot of these types of stocks on this Bear Tracks list. Now, in particular, we're looking at horizontal level breakdowns with a little bit of a value gap. And I didn't see any, to be honest with you, in today's Bear report. But we're going to look at some of these different types of setups. Once again, companies that, how the hell are these down as much as they are? Merck, which peaked in the middle of 2024. The entire healthcare sector really started to die second half of 2024. Merck did not evade the drawdowns here, currently down 36, 37% off of its all-time high peak in the middle of 2024. What we're looking for here is a potential floor to be found in Merck and then maybe a rally back to the upside. But if we get back up towards 97, 98 bucks, this is a potential short on a re-entry back up here for lower lows. If Merck doesn't turn it around, once again, has nothing to do with its fundamentals. I don't care about the drugs in the pipeline. I don't care about anything other than the fact that right now it's trading below its downward sloping 200 moving average. It's in a series of lower highs and lower lows. It broke a previously important support level, and now it's in free fall mode. Eventually, we would expect that to find a floor. If you're a long bias trader in these types of situations, you would expect to buy the right side of the V, let it find a floor and start to bounce. If you're looking to short weakness, this is a good opportunity to throw some alerts somewhere around 95, 96 bucks on Merck. We rally back up there, opportunity to potentially short it back down. Next one that I want to point out here that was actually on our list for a while. Nobody took the short, but that's okay. It looks like it's still on the short. We're looking to play the breakdown here of this previous resistance now turned support level. We got a little bit of a breakdown with a bounce back. This is what I'm talking about with Merck. We call this our BRB setup. Breakout to the downside, retest of previous support now turned resistance, and then the follow through, right? The bounce back to the downside. TXT 52-week lows here. This is an aerospace and defense name that is in free fall mode at this point. We have a price target down here at 60 bucks. Opportunity to own this thing from 73 to 60. There is a decent amount of options opportunity in TXT. We keep going down the list. There's a lot of names that are surprising. We have a lot of consumer staples names, which I'm surprised about because there has been some relative strength in consumer staples over the last couple of weeks. But we're seeing things like General Mills on the list, Archer Daniels Midland on the list, Constellation Brands, right? If you are a beer drinker, this should be a big wake-up call, right? Constellation Brands is huge when it comes to beverages and food type of products, right? This is a $30 billion company that owns a lot of our favorite brands that is currently down 40% from its peak in late 2023, early 2024, just in straight up free fall mode. Once again, cheap tends to get cheaper. If you tried to buy the dip here off of, I'm assuming, a bad earnings report, this would have continued to crush you. So I'm surprised to see some of the names on here. Moderna, Pepsi is on the list of potential super weak stocks here. How about a difference between Pepsi and Coke? Right, we had a short initiated at 160. It's currently trading at 144. We're looking for these cascading style of we call them capitulation zones, where you see these previous areas of support with very little volume underneath just get absolutely trashed. Right, we see these big moves. PEP is a 1.65 ADR, so to see a 2 to 3x move ADR in a single day is huge, and we saw it on the drawdown. Compare Pepsi to Coca-Cola over the last couple of days, by the way. The market does a great job at sniffing out who's the leader and who's not. So on the flip side, if you're looking too long, a consumer staples related name, and you're looking at soft drinks or beverages, Coca-Cola versus Pepsi, it's very obvious to me that Coca-Cola is the winner here. So Pepsi, a continued short here, still looks like crap, not something I want to own. And then a bunch of other names, Halliburton, oil and gas names, etc. What I want to do really quick before I answer any questions, I want to show you guys how we would build a scanner from scratch. Just to find some of this weakness here, we can immediately filter out kind of these ETFs. We don't want any ETFs in there. First thing we want to do is look at 50-day lows. That's going to give us 204 names. We want optionable and shortable to be on there, so that whittles it down to 148. Let's throw a volume construct on there of over 1 million. Now we got 61. So we just went from a couple hundred down to 61. And then we're also going to throw a mid cap on there. Let's only go, not 2 billion. Let's go over 10 billion. So over 10 billion. So we're looking at technically large caps at 50-day lows with options and they're shortable and average volume over 1 million. And if we go ahead and sort this through by chart, we can see what types of stocks are here. Datadog. This was a meme phase craze back in 2020, 2021. Very surprised to see First Solar on this list. Very, very, very surprised to see First Solar. This is the leading solar stock to own in the large cap space if solar ever does turn it around. Very surprising to see First Solar die off as much as it did after it peaked in late Q2 of 2024. So First Solar there. These are names we don't want to buy on the way down. We want to wait until they find some sort of floor. How about this one? Ever since Trump was elected, Lockheed Martin has discounted itself 30% or so. The market has brought this thing down almost 30%. So for those of you that expect the Trump administration to get into mass wars, the stock market, at least in terms of Lockheed Martin, saying it's probably not going to happen. This is why I love the market, by the way. Everybody has political opinions on things that are going to happen. Go look at the stock market. Is aerospace and defense breaking out into all-time highs? Are these types of companies that would obviously make a bunch of money if there was a large-scale conflict in place going up? If they're not, you got to ask yourself, what are the legitimate chances that it's going to happen? You bet your ass smart money, and I use smart money in quotes, but guys and gals and financial institutions and large money managers that have, or that are privy to insider information that us plebeians don't have, right? Retail traders don't get this stuff, but at an institutional level they might, or a political level they might. Are these positions being bought? No, they're not. And so big money is moving out of these types of plays, and they don't do that if they expect to make money to the upside in them, right? Something to think about there. Once again, Merck. TTD, this was a big surprise. Let's talk about TTD for a second. This is our COD potential setup here in TTD. You can see we had a previous trade on this that ended up working okay. Didn't hit our price target within our expiration, but it was a winning trade from TTD. But now we're right back into the same range that we were in from 2021 until the middle of 2024. It's a bummer for people that were holding TTD, expecting this to continue to run with the broader market. As of right now, this is a no trade zone from the long side and the short side. Put premiums are going to be way too crazy right now, but this is very obviously not a buy the dip situation until minimum we're back up and over 97.5. What I'm looking for is a rally back up to 97.5 and a potential short back down. This is a play that has plenty of options liquidity. We'll see what puts our costing in terms of the last 52 weeks when it gets back up there to 97.5, if it does. As of right now, this is a watch list candidate looking for a major pullback and then a potential short on the next leg down. I'm going to show you one more trick here. So these are 50-day lows. These are names that are already breaking down. And so for us, we don't mind because we like to buy pullbacks to the upside and downside. But if you want to try to front run or do whatever you want, you go 0 to 5% above the low. So these are names that are essentially basing above their 50-day low. And so these are a lot of the times these stocks are trading at like support levels that you could potentially get into on a breakout, or if you want to try to front run like a madman, feel free. First one that pops up is Aflac. You can see here, very obvious short on Aflac. If it does break below, we could say nice big round number at $100. $100 is a nice big round number. Market tends to like those types of numbers. We get down below $100. This is a potential short on a rounded top type of pattern. Price target would be 85 to the downside. Previous resistance now turned potential support. So a little bit of a short there from $100 down towards 85, opening up a 15% move to the downside. It's worth your time. So if you're looking to short a little bit lower volatility than what we normally like to short in terms of individual stocks, but Aflac has a potential setup there. You got massive names like American Homes for Rent, these REITs, $15 billion REITs here. See, there's 11 pages. I'm not going to go through all 11, but really a nice scanner to throw these types of shorts on your list. So if you're the type of guy that doesn't like trading with the trend because it's still firmly up across the market, or you're looking to build out a watch list of weak names that if this market does fake out at all-time highs, and next thing you know, in a couple of weeks, we're potentially pressing into 50-day lows in the indexes, who knows? This watch list you're building out starting potentially today is going to come in handy because these stocks are not working well in a market where most things right now are continuing to go up. So not a bad place to start. As you can see, I'm kind of looking through all of these things. Nothing really stands out yet that I haven't already talked about. But once again, you can steal this scanner for me. It's very basic. Add anything you want to do. Throw relative volume on there if you want. Whatever makes sense. Right, guys? So once again, I think, go back to TradingView, I don't think this is the time to be opening up lots of shorts. The markets are screaming upwards today. Does it stick? I have no idea, but we've been consolidating for multiple months now. A lot of the times people get bearish when markets don't do anything, not because, there's any real reason to. They just get bored. Then headlines start coming out. Well, why isn't the market going up? We have a million different things, right? We have Chinese AI through DeepSeek. We have tariffs through Trump. We have hot CPI and PPI yesterday and today, and yet the market continues to rally higher. Also on the backside of bearish sentiment in retail. This is a one-year low in bullishness in retail. They're more bearish now than at any point in the last year. These types of extremes tend to get reversed, meaning retail right now, the spread between bullish and bearish is about 20%, which is an extreme reading. These are the types of scenarios where you see retail get left in the dust because right now institutions are very clearly still buying. Retail is not. We know that because they are literally at one-year lows in terms of bullishness. So whether or not you want to short this, I don't agree shorting here, but building the watch list I think is very valuable, because if for whatever reason over the next couple of weeks these indexes do start breaking down, that watch list more than likely is going to hold big losers, and obviously that's what you want if you're shorting. Okay, so that's what I got for you today. Bear tracks. Weakest stocks in the market. Markets are ripping. Those stocks are not. Throw them on a watch list. Market flips, feel free to short those. If you have anything that I did not see, if they didn't pop up on the scans you really like as a short, feel free to leave it as a comment below, and I will let you know if we've looked at it or if we plan on owning it. I think that'll be cool. Okay? My name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe. And please, for the love of God, stop reading headlines. There's been 3 world-ending events in the last 3 weeks, and the markets are less than 1% away from all-time highs. It's not our job to tell the market it's wrong. It's just to make money. All right? Catch you tomorrow, 11 a.m. Eastern, for the Crypto Report. See ya. I will email you back as soon as lunch is over.